Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He's a hedge fund manager at Bearing Asset Management. He's been a financial professional, an investor, and a short seller for over 3 decades. He's successfully shorted the 2000 technology bubble, the 2008 bubble, and he was featured in Barron's in an article along with his then business partner, Bill Wagner. Kevin Duffy, thank you for joining me again.
Thanks, Jason. Good to be with you.
Now, Kevin, rather than spending all the time analyzing markets, I think you want to go in a different direction because of all the craziness that these central bankers have been saying in interviews lately. There's been about 5 or 6 really, I would call them ridiculous, tone-deaf, out of touch with reality statements, basically on the par, I would say, with Marie Antoinette's let them eat cake. You have Christine Lagarde, who is saying that people should just be happy with a job. They should not care about their savings anymore. You have Neel Kashkari of the Minneapolis Federal Reserve. He's talking about how central banks need to do even more to redistribute wealth to the poor, I guess. But I thought they're already redistributing wealth, but I guess it's only been to the rich, right, who own the stocks, bonds, and real estate that have been going up in this everything bubble for 10 years. You have Jerome Powell in a press conference talking recently about how the Federal Reserve needs to do more to help the poor. And then I think today, I forget the guy's name. There was another interview I just saw going on with another central banker. Forget which central bank. I'll look it up later. I'll try to find the article link for the listeners of this podcast show on Friday, November 29th. I'll put it in the information and description section. And this guy was extremely hubristic. He was, how dare you criticize us central bankers? We saved you from 2008. It seems everything's going off the rails, Kevin. There's a lot of central planning here, massive amounts of intervention and rules changes, and yet capitalism is getting blamed. Is this behavior normal?
Is it normal? It's become normal. It's become normal. It was only, 2008 was only 11 years ago that, we were in the throes of meltdown, and central bankers were on the defensive, and they were being criticized, and the bailouts at first didn't fly. There was a lot of blowback from that, and people didn't trust central bankers. We saw the bursting of the housing and the credit bubble, and, we've just come full circle, and now you've got Hank Paulson writing books, and they're all patting themselves on the back. So, markets, the pendulum swings, and we've gone from one extreme to another. And, now we're at the point in the cycle where the central bankers are seen as being totally in control. The investing public basically is looking at the S&P 500 index fund as a piggy bank, and the feeling is that the worst we can have is a 5%, maybe a 10% correction, and the central banks can always come in and ride in on their white horses and save the day. So I think from a sentiment standpoint, this is what you would expect at the top of, or at or near the top of a bubble, is to have this kind of hubris. That kind of sets us up in terms of what's next, and we've seen some pretty crazy things. I mean, $17 trillion in bonds yielding negative yields, actually paying governments to borrow money. It's something I never could have imagined.
There's so many more examples of just craziness now. They're claiming that the U.S. economy is still doing well, but then how come there's been 3 rate cuts since July? Normally rate cuts don't happen when the economy is still in economic expansion. We're over 120 months now, 123, 124 months now of supposed economic expansion, yet we have rate cuts. We also have not QE now, that's $60 billion per month. On top of that, we have this massive amount of repo madness. It started off small. None of it was supposed to be added to the Fed's balance sheet. And yet here we are, we're almost $300 billion. I didn't check the Fed's balance sheet today to see if they updated it, but it was about $260 billion increase in only 3 months. Repo madness, which is mostly overnight loans and then term loans of 14-day and I think now 42-day, that's averaging, I think, $300 billion per day in repo madness that they tell us is only temporary and the average person shouldn't worry about. So all these things, they're changing the rules. They're telling us They're placating us. They're trying to keep us calm. But beneath the surface, it seems that things have gotten a lot worse.
Well, every bubble is similar, and every bubble is different. You have, what seeds the bubble is artificially low rates, compliments of the central bankers. But, where the money flows, the monetary, so what they're creating is monetary inflation. But monetary inflation doesn't always lead to price inflation. And I think we have to really differentiate there. Like I said, every bubble is different. And if you look at the tech bubble, for example, the money went into money-losing .coms. And, there was some substance, obviously, with the Internet. It ended up probably being even greater than many people predicted back in the late 90s and the early 2000s. But the first wave of pioneers really took the arrows in the back, and there were some survivors, and some of these companies like Amazon and Google, of course. But and then you had the housing bubble, and, the money flowed into a different area. It flowed into McMansions and mortgage equity withdrawal and mortgage debt and that sort of thing, and also retail, big box retailing. So I think what's interesting is how that money flowed into areas that really didn't make any sense, because at the same time that retail square footage was growing 8% a year in the mid 2000s, online retailing was starting to gain some momentum. And also the big bulge from the baby boom generation, high consumption, was starting to age, and so consumption was going to go down, and so there was a lot of malinvestment, and this is the problem with the monetary inflation. Where does it go, and where do you look for cracks? The first signs that there was trouble back in the housing bubble was the first quarter of 2006, because that's when overall housing prices started to go down. And then the bubble really, kept going for a while. Then you had the subprime cracks in early 2007, and then it was really later in 2007 and early 2008 that things started to really unravel. So I think what we need to do is focus on where did the monetary inflation go this time, because every bubble's different, and typically what happens is once the bubble bursts, you get a hole in the balloon, and the new money's not going to flow into the old balloon. It's going to find a new path, a path of least resistance. So, where did it go this time? Well, a lot of it went into tech unicorns, money-losing companies, and the idea was that, every business idea out there, every business model was going to be the next Amazon, because this paid off. They lost billions of dollars, but it eventually paid off, and they built a $1 trillion business. It also flowed into governments. It flowed into governments able to borrow at negative rates, and we can talk about some of the excesses there. But I think, if we're looking for a change, the idea that the central bankers might be losing control, I think we need to really focus on two areas. One is the IPO window that's come out, and the other second is the bond market, especially the government bond market.
Yeah, there's been a lot of problems with the angel investors and the venture capitalists dumping IPOs back onto the publicly traded markets lately at overinflated values. The WeWork one is extremely well publicized, but some of the other ones have also had problems. It was very predictable, Kevin, that Beyond Meat and Tilray, some of these other ones that just kept promoting EBITDA growth, and they didn't. I was looking through the financials of Tilray, I remember, over a year ago, and the disclosures in the financials there, in their annual reports from the lawyers were pretty outrageous about how the company may never be profitable, hasn't been profitable in 10 years, outlining how the management is not even very good at what they do, and other things in there. So that was predictable that Tilray was going to have problems, and others, and yet there were investors for a while that bought these things hand over fist.
Yeah, and this is the thing that you see at Bubbles. You see this just crazy excess. WeWork, unfortunately, never went public, and I think SoftBank, the big investor in a lot of these tech unicorns like Uber, as well. They've lost something like $5 billion already on their WeWork investment, and they. Masa Son had a lot of confidence in Adam Neumann, young guy, and you start reading about this guy was really off the rails. He was talk about hubris. Elon he puts Elon Musk to shame. He was talking about, some of his goals in life were, 1, live forever, 2, become the first trillionaire. You just can't make this stuff up. And, Beyond Meat is another one. This company goes public at 25. It goes up almost tenfold. The valuation got up to $15 trillion. And, to their credit, they're
trillion?
Actually, I'm sorry. Did I say trillion? Billion. $15 billion.
Yeah. Not yet. We're not there yet.
No. So I guess it could get crazier. But this is the kind of thing that you see. Uber has lost $20 billion in operating losses over the last 5 years. That's never happened to my knowledge, not even close. So, but what I think is interesting is when these companies were not public, you didn't know what was there. You had a sense that there must be some substance there. And now that we get to actually comb through and look at the financials and read the footnotes and everything, and then hear some of the comments coming out of these people, you realize that it's even worse. I suspected it was pretty bad, but it's crazier and even worse than I even suspected. So
yeah, it's mass delusion.
It really is. And what's interesting though is that the IPO window. We had certainly the frothiest IPO market that we've seen since 2000, without question, has been this year. And but the market is really starting. You look at Beyond Meat; it goes from 25 to 240. It's an $82 stock. $83 stock right now. Uber has been a bust. You see a lot of these big IPOs. WeWork, they were expecting to go public, and they never even were able to do that. So, this is a sign that path to monetary inflation, I think, is really critical, and for a number of reasons. But right now, that game is over. It really appears to be over, and it seems to me like there is a hole in that balloon. And this is the thing: is once you start, we know that the central bankers are going to continue to print money. They're going to continue to try to pump up balloons, and but once a balloon has a hole in it, forget it. It's not going to take the new money. So where is that money going to go? Well, I think it's interesting that these money-losing tech unicorns, they have really helped to dampen price inflation. I think that's one reason why monetary inflation hasn't just necessarily translated into price inflation. The other reason is that a lot of the monetary inflation went into asset inflation. So, it's going to be interesting if they keep on printing money. Does that now try to find a new balloon, and do we start to see more signs of price inflation?
Yeah, the everything bubble, so much of central banks manipulating interest rates down, the majority of that money, it did not go to Main Street. Main Street has not benefited. It's not like people are getting lower interest rates on their credit cards or anything like that. Although there is a lot of subprime auto loan debt, but that's teaser stuff, and the interest rates then spike high and people are defaulting in record amounts, or they're record delays, record late on their payments. But the amount of share buybacks, the ratings agencies, the stuff they're doing, refusing to downgrade below BBB, The majority of this money and credit with the Cantillon effect, it's gone to overly indebted governments that have refused to cut their budgets. You have the U.S. government, both the Republicans and the Democrats want to run trillion-dollar deficits. They might want to, they totally disagree, I would say, on where to spend the money, most of it at least. But, you know, a lot of the policies are very similar in terms of they don't want to cut any spending significantly. You have the corporations, large corporations that are able to continue borrowing and the amount of share buybacks. And that's causing the people recognize this, that people are getting away with fraud. You know, corporate insiders, they're doing share buybacks with debt. They're keeping the stock price up, and they're dumping record amounts of shares. So they're using a share buyback with debt to cash out of the company at record high share prices, and they're loading the balance sheet long-term with debt so the insiders can cash out without crashing the stock price. That seems like fraud to me, Kevin. At least in the past it would have been fraud.
Well, there are certainly incentives, and I think, you know, we have to be really careful with the stock market. I really believe that it's a market of stocks, not a stock market, and you know, you can't really generalize. I mean, you can, but I think we just have to be careful because there's a lot of nuance that's very important, and I think there are, you know, multiple areas of the stock market. You know, one we just talked about, these money losing companies. I think that's going away, and that's a healthy thing. You know, you also have some of the large defensive companies, bureaucratic, and even, well, let's take the large, the FANG companies, you know, the large tech companies. They've had access to you know, cheap capital. They've been profitable. They've been generating lots of cash flow. A company like Apple, I mean, they're just hugely profitable. Let's see, the last 12 months, $64 billion in operating income. So, you know, every company is different, and you know, some companies it does make sense to buy back their stock. I mean, if the stock is cheap and they don't have good places to reinvest the money, then it does make sense to buy back their stock. But I agree with you that there are some problems out there. And so, you know, if we kind of segregate, you look at, all right, the big tech companies, you know, one of the problems is that they've become very political. And I think a company like Apple, they have exposure to China and the trade war, and they are really, I mean, they've been super aggressive on buybacks, taking on debt. I mean, they still have net cash on the balance sheet, but they're saving less and less for a rainy day. And the company, they're actually, they show negative gross profit growth over the last 12 months. Then you have large corporations that are becoming, you know, they're becoming very politicized, very sort of politically correct, and also, you know, many of these are doing, like you said, taking on debt to buy back stock. The valuations are huge. And of course, the money is just pouring into them. The stock's going up in part because of the indexing trend. But then there are a lot of companies out there that don't just fit into the indexes, and you know, there are opportunities out there. They're not but they're not in those places like the big bureaucratic companies and the big tech companies and the money losing unicorns.
So I know you've been a successful short seller for decades now. You've been doing it. You've made a living doing this successfully. You were featured in Barron's, which is very impressive for your shorting in 2008. So recently, I'm not sure if you saw this, there was an extensive article on Reuters that came out in the last week or so. Carson Block was quoted. He warned people about all these Chinese reverse merger fraud, and he was featured in the documentary China Hustle. He's a very activist short seller now. And lately, more governments, whether it's South Korea, European Union, and others, are talking about potentially banning short selling. How do you feel about this? Do you think they can actually do this? And what type of unintended consequences or damages could this do to what's left of markets if these governments actually do try to ban short selling?
Well, I think right now that short selling is still it's so tiny, and you look at the short seller. They're really price discovery agents, and they are very important to help ferret out fraud. So, and what this cycle has done to short sellers, including us, I mean, it's just been absolutely brutal. I mean, this has been the worst year I've ever gone through. And when you say we've been successful, well, we've been successful in the past, but I mean, this cycle in the last 5 years, it's just been a bloodbath. It's been just so difficult to be a short seller. So, that said, where was I going with this? The short seller is important in terms of price discovery, and that I think we're so tiny right now. If you look at the total ETF assets that are in bear funds, inverse funds, it's 0.3%. It's next to nothing. So, if the short sellers are just about wiped out anyway. So, first of all, I'm not sure why any government is going to really benefit from banning short selling, other than the fact to have a scapegoat. But is it going to make any difference? No, because I think that they've already been destroyed anyway, quite frankly. And this is a problem with bubbles, and especially the current bubble, is that, and it's also the problem with socialism, is that you're basically, the planners are flying blind without the price discovery that's going, in terms of interest rates. That's not price discovery. It's set by central banks. In terms of index funds, people aren't buying stocks, going out and actively managing and doing their research. No, they're just blindly buying the index. Who cares about? So there's a lot of price insensitive buying. You have pension funds and banks and insurance companies that are basically forced in Europe. They're forced to buy this negatively yielding debt, because you ask the question, who in the world would buy bonds that have negative yields? You're guaranteed to lose money. Well, these are price-insensitive buyers, and I think capitalism does not work without price discovery. And that's a common theme right now. You look everywhere, and you've seen, whether it be the short seller or whether it be the active investor, they're just about going extinct.
There's a lot of mass delusions right now. Things that used to be conventional wisdom for investing in markets have been turned on their head lately. I would say thanks to central banker intervention and rules changes. So now you have people, in the past, bonds used to be a safer, more reliable form of investment income. You were capping your upside, and you were sacrificing any upside for a safer yield, for safer income, especially like government bonds in the past. Now you have people buying stocks for safer income, which is ridiculous considering the valuations people are paying for some of these stocks and the rot of the balance sheet, and how these companies are getting away with it because they're not being held to debt-to-equity ratios, debt-to-cash flow ratios that they should be. The ratings agencies are only looking at debt-to-EBITDA ratios, and those are very lax. And then people are now buying bonds, Kevin. You talked about negative yield, but the people, why would they buy negative yielding bonds? Number one, if they're professional money managers, they can't be in all cash, right? They could get fired, career risk. So if they go to too much cash, they're automatically risking their career. If they're a professional bond fund investor, they can't be in all cash. They'll get fired. That'll be it. So they have to buy something. And it seems that now no one's buying bonds for income for the most part, although on a relative basis, U.S. Treasury bonds still have more positive yield than anywhere else. But people are now buying bonds for capital gains. So stocks and bonds have done a really crazy reversal compared to conventional finance for over 100 years.
Exactly. I know the world is really upside down. It's strange. I mean, you're right. Some buyers are buying bonds because they're forced to, like these banks and insurance companies. The regulators are basically, they're going to the regulators and saying, we're going to lose money. This is no longer a low risk investment. Well, according to our definition, it is. So you have to buy it. Then you have the asset allocators. Well, we're buying bonds for diversification, but nobody is really looking at what they're getting, the value proposition. And then you have the traders. The traders are buying bonds because they have momentum. So you have a lot of really questionable reasons why bond investors are actually buying bonds. And I really believe that the difference between these bubbles that we've seen over the past few couple of decades, especially the tech bubble and the housing and credit bubble, is that the first two were really sector specific, and there were places to hide. There were always places to hide, okay, and that's something we can talk about, bubbles and anti-bubbles. But there were places to hide. You could hide in bonds in 2000. You could hide in equity income funds. You could hide in REITs, and those all were great diversifiers when the bear market came. The same thing in 2007. But I think this time is different because it's not a sector-specific bubble this time. It's a much broader bubble, and at the core, at the epicenter of this bubble, I believe, is a bond bubble. And I don't think we've ever seen anything like this. That's the difference right now. So, you have to watch the bond market, and bonds are not going to be the great diversifier. They're not going to be the shock absorber that they were before, and that's going to have all kinds of reverberations. You're going to see problems in pension funds because they've been sort of drinking the diversification Kool-Aid. A lot of pension consultants, that's what they sell. That's their whole pitch. Oh, you just need to be diversified. And, hey, of course, it's worked on the upside so far. It's worked great. And anybody who is diversified this year is having a good year because bonds have done well. Gold has done well. Not that they're diversifying into gold, but, if you diversified real estate, gold, stocks, bonds, you're doing fine this year. But I don't think it's going to work in reverse, not this time.
Yeah, I agree. The bond bubble is absolutely enormous. These governments are so overly indebted. The central banks and governments bailed out the banks in 2008. So all that extra liability was put onto governments and central banks. Well, who's going to bail them out in the next crisis? Or are they just going to keep changing the rules and telling people and blaming capitalism? That seems to be the narrative now, is that the central bankers are preparing to constantly keep changing the rules. You have Lael Brainerd talking about capping rates here in the U.S., copying what Japan is doing, Japanification, and there's a growing populism movement here in the U.S. among adults about MMT, and the Democrats are widely embracing that. You have these politicians, whether it's Bernie Sanders, Elizabeth Warren, Andrew Yang, they're promising people universal basic income, $1,000 a month. $1,000 a month, yeah, oh yeah. People can vote themselves an extra $1,000 a month. Where's that money going to come from? And then free health care, free education, all these things. There is no such thing as a free lunch.
Right, and you know what? I think one of the hallmarks of bubbles is the denial, the delusion, and it is a collective madness that takes place. I think back on a quote by Scott Peck in The Road Less Traveled. Mental health is a dedication, an ongoing process of the dedication to the pursuit of reality at all costs. And so the corollary of that is, what is mental illness? It's a detachment from a reality. It's a willingness to basically give up in the pursuit of reality. And I think that really describes what has been going on in many ways. You see this it's not just in the financial markets that you see this. You just see it in the behavior of people. You see it in their understanding of history. It's so many things. And the attitude towards modern monetary theory, basically that we can just print money and that will just make all of our problems go away. This is, and the Democrats basically wanting to give away, quote, free stuff. I mean, this is hubris, very much like Adam Newman wanting to live forever or become the first trillionaire. It's just, it's hubris on an epic scale.
Yeah, do you think MMT can make things a lot worse, or do you think that they're going to be able to print all this extra money? Because the justification is they're saying that officially, with the official government statistics here in the U.S., there was very little inflation, and the Fed's balance sheet went from, $800 billion before the 2008 financial crisis up to as high as $4.5 trillion officially, and they're saying that wasn't inflationary, and they're saying that they can do more without causing inflation.
Yes, and, I think that's a great point, Jason, and, going back to what I discussed earlier with the IPO market, that window closing for money-losing companies, and the fact that the monetary inflation has flowed into basically price deflation. I think that is huge, and that window is shutting. And this is the problem, is that the central bankers, right now they're feeling very confident, but they don't control. Ultimately, they don't control where the money goes. They can print it all they want, but they don't control where it goes. And what the market is telling you right now is it is gagging on pouring that into money-losing ventures that are going to translate into price deflation. That game is over. So, this is interesting, right? Because we know they're going to keep printing money.
Well, it's not. So all these major economies and central banks are doing it now. So initially what this started 30 years ago with what Japan did, right? Because they wouldn't allow their banks to go bankrupt. And they were able to export a lot of that monetary inflation. So they were doing this for starting about 30 years ago. They were the only country at the time doing this. And then in 2008, after 2008, you had the U.S., the European Central Bank, and China all start to do massive amounts of stimulus, balance sheet expansion. And now they're talking, all three of those major central banks are talking about copying Japan and, manipulating interest rates down to zero, expanding the balance sheets of the central bank, and all this other interventionist policy. I don't think the global economy can handle all these governments and central banks all doing the same thing at once.
Well, let's follow this to its logical conclusion, and this is just a scenario that I'm going to paint. Like I said, I really believe that one of the keys here is that the spigot is shutting off towards the money-losing tech unicorns. Okay, but we both agree that they're going to keep the spigot wide open. In fact, they might even open it more, especially as they get more and more desperate. So where is this money going to go? If it starts to show up in price inflation, and what is that going to do to the stock and the bond markets? Well, we know what it's going to do to the bond market. The bond market can't handle that. And so now you've got the core of this bubble is a bond bubble. And you've already seen some pretty good declines in the bond market. There's been a rally recently, but the TLT at one point was down about 8% from August. I know if you take some extreme examples like the Argentine 100-year bond, I think it got cut in half in a few months. So we have already started to feel some pain there. But imagine the markets start to sniff out price inflation. That's going to crush the bond market. If you take the bond market away and you take the tech money, the tech unicorn market away, what does the stock market have? And it starts to get a whiff of price inflation from these levels with these valuations. And we already know that by definition, these money-losing companies like Uber and the rest of it, they're not going to support the market. And also, there is a secondary effect in terms of, or derivative effect in terms of the companies like an Amazon that is benefiting, AWS benefiting somewhat from the venture capital ecosystem. And we saw this in 2000, by the way, where where the dot-com bubble burst, and what was keeping that afloat? It was the monetary inflation. The money was just pouring into these money-losing ventures, and then once that bubble burst and the spigot shut off, the market continued to drive up companies like Cisco and Intel and Sun Microsystems, and thinking that, these are real companies. Well, the problem is they were selling equipment to the dot-coms, and they were somewhat dependent on the dot-coms. So when that went away, then there was a secondary effect, and that's when you saw the peak. So I think this, that's something that, to me, this is key. That the fact that this spigot is shutting off for money-losing ventures, and I just don't see where that's going to continue at this point. I think that's the beginning of the end of the whole thing.
Yeah, and SoftBank, you mentioned SoftBank earlier in the interview. SoftBank has been borrowing debt from Japanese investors to gamble in these very highly speculative, highly risky, unprofitable unicorn technology stocks. So that's not a good long-term strategy, is using debt to gamble on these basically tech Ponzi schemes that are revenue growth only with very little hopes of becoming profitable. I think, Kevin, you've been talking a lot about the U.S. in this interview. I think the problems are absolutely massive with the global economy. There's big global macro problems. There's a lot of data that the global economy has been slowing down rapidly for at least a year now in emerging markets and China. And one of the major problems, Kevin, I think, is these governments and private businesses in China and emerging markets, they gambled that the dollar, starting in 2010 and 11, when Ben Bernanke was doing those QE programs, the dollar was going to remain very weak and continue to be weak, that the Fed balance sheet was going to expand beyond $4.5 trillion, a lot beyond that. And so they took out all this dollar-denominated debt. The amount of dollar-denominated debt has more than doubled. I think it was like $5 trillion approximately in 2009, and since then, it's over $11 trillion now. So they've gambled betting against the dollar, and on a relative basis, the dollar is still above 98.27 on the dollar index, and on the trade-weighted dollar index, it was close to an all-time high. So that relatively stronger dollar against the other currencies, that's really hurt China and the emerging markets, besides all the other problems in the global economy, all the data that you and I have been looking at.
Yeah, Jason, I think you make a good point, because all this, we have a tremendous amount of leverage in the system, and the problem with leverage is it's not designed to go in reverse. And this is the problem. Once things start to reverse, you start to tip over these dominoes. We've still got a tremendous amount of margin debt that's outstanding. And then, it doesn't take a whole lot. You throw in a trade war, and even if the trade war gets resolved, the damage has already been done. And you throw that on top of a very weak, global economy. It's mainly the U.S. economy that's been able to carry things. But how much of the U.S. economy is based on asset inflation? How much of it is based on the bubble with tech unicorns, and these things are starting to unravel. So, it's kind of like of course, we'll know. What is the straw that breaks the camel's back? I mean, we'll know in hindsight, but none of us will really know until then. But we keep on just adding more and more stress to the camel, and at some point it's all going to go.
Have you seen the China Hustle documentary? Because I know, with retail investors, they were hurt really badly with those Chinese reverse merger frauds. Do you still think that there's a lot of fraud from publicly listed Chinese companies here in the U.S.?
I'm not really sure. I know that that there was before. I don't really have a strong opinion on that. I mean, I tend to feel that the Chinese economy. I mean, the problem. They were really the stimulus at the margin. There was something that was different back in 2009. And they really got things going in a big way. So I think we do definitely have to pay attention to what's going on in China. And, we're seeing, every bubble, this is the thing that Austrian economics teaches, is that that bubbles really result in malinvestment. They result in money flowing into some areas that shouldn't get the money, and also you see the mirror image of that. You see areas that are starved for capital that shouldn't be starved for capital, and which tend to be the better areas to invest in. So what's going on in China and the empty cities and things like that, I mean, that's kind of Exhibit A or Exhibit B in terms of malinvestment, Silicon Valley, the tech unicorns, and then Washington, D.C., all the insanity. I mean, I know we could probably talk for days about the excess in Washington, D.C., but it's not something that gets publicized because the mainstream media is kind of culturally against doing that sort of thing. But
that's right. I emailed you some articles about the construction cranes. If you can't come here and visit, and you monitor all the construction cranes all over the DC metro area, it's nuts.
Yeah, so that's where every bubble's different. The malinvestment's different. Where the monetary inflation flows, and I think it's pretty obvious where it's gone, and we just have to look at these balloons no longer taking the new money. And I think the first big obvious one is the money losing tech companies, and you're seeing things slow down in China. The trade war, like I said, that's not going to. That's sort of just the wrong idea at the exact wrong time, which again is another sign of hubris. I mean, to think that you can with this situation fight a trade war. I mean, that's really a sign of overconfidence and a fair amount of economic ignorance as well.
In wrapping up this interview, Kevin, I think we've identified a lot of the problems. Now, in 2020, with the presidential election coming up next year, I think a lot of people they identify a lot of the problems in society, that there is a wealth disparity. They're not blaming, in my opinion, the central banks enough and the politicians and central planning that have gone on. The central bankers are not being blamed for this. I don't see enough articles in mainstream media or mainstream financial media blaming central bankers. So do you expect socialism to continue to become popular? Because it seems that people are identifying at least some of the problems in society, but then their solution, and I'm using air quotes, is it's capitalism's fault. There needs to be larger government, more central planning, more taxes, more socialism. That seems to be a major trend that people like you and me are trying to speak out against, but a lot of people are ignoring that and, saying we need MMT, we need socialism, whether that's in the European Union and United Kingdom or U.S.
Yeah, well, that's we could talk about that for days. That's a really good question, and I'm not sure I've got a great answer to that. Clearly, you do have different attitudes with different generations, and the millennials seem to be more willing to experiment with things like socialism. I tend to believe that in terms of the election next year, that's another thing that is a risk. I don't think the market is really factoring that in a whole heck of a lot. And I've been really following Austrian economics and politics to a certain extent for about 30 years. And my sort of default position on elections and the right-left political spectrum was there really wasn't a whole lot of difference in terms of what was going to get done. Didn't matter whether you had a Democratic president or Republican president. And you can go back and you can look at the growth in government over the different administrations going back to 1960, and you can see that there's really very little difference between the two parties. If you look at the actual statistics, and I know that the statistics don't tell you everything. You have to certainly take into account wars and that sort of thing. But I think people would be surprised at actually the spending since 1960 spending, if you adjust for inflation and population growth, on average has been higher under Republican administrations. So essentially, despite all the rhetoric on the right about limiting government, they're not even really talking about limiting government at this point. They're really here we are in a boom, not a boom, but an economic expansion, a long economic expansion, and we're already right on the cusp of running $1 trillion deficit. I mean, this is unheard of. It's one thing to run huge deficits in a downturn, but it's another thing to run them, as the economy is expanding. So, but that narrative, that and that position that I've kind of taken over the last 3 years, I'm starting to question that. Is 2020? Is this going to be a kind of a sea change in terms of there being an actual difference between the two parties, that you actually have a choice and that it would actually make sense to go to the election? I don't know. I'm just, I'm asking the question because I think that
both parties like to spend a lot. I think it's very clear, but the Republicans are not promising, to everyone gets free health care, student loan debts canceled, $1,000. They're not making those types of Green New Deal for trillions of dollars. They're not making those types of promises. But yes, both parties want to spend. I think they just disagree where to spend it, though.
Yeah, but I think you make a good point, and this kind of brings me back to the original point that I was making, and I think it fits in with the idea of a delusion and the hubris that you see at the top of a cycle or a top of a bubble, and that is that the Democratic Party. I mean, if they had any sense, they would have just basically kind of swallowed their pride a little bit and basically just let Trump fall on his own sword, run up huge deficits, let the bubble burst. The economy would be in a recession by the time of the 2020 election, and then you could just walk in and just stay moderate. Don't get too crazy. Sound like the party of reason, relative reason. And if it means you lie through your teeth, who cares? That's what politicians do. But no, instead,
that's how FDR won. That's how FDR won his first presidential election.
Exactly, yeah. And exactly. That's how he ran against Hoover, the big spending Hoover. Totally right on. And also, and then later elections, he said, I'm going to keep the boys out of World War II. So, he knew how to get elected. He did it 4 times. But the Democrats. Instead, you really see this overconfidence in terms of shifting even further left, and I think this is a complete detachment from reality. They think that the government the taxpayer has unlimited deep pockets, that basically money grows on trees or it comes from the North Pole or whatever, and now Imagine that we're in a recession next year, or we're starting to be in a recession, the stock market's going down, people are starting to get nervous. And now you have the Democrats calling for all this free stuff and calling for very radical economic policies. I think that there could be potentially a backlash against that. The other scenario is that they actually win and that they actually follow through on some of this stuff, unlike what we've really seen over the last 30 years, where there isn't a whole lot of difference in terms of practice between the two parties. The system just kind of chugs along. I think it is at least a scenario worth considering, that we make this great leap forward into more experimentation and a real heavy dose of government intervention, and not just on the monetary side but on the fiscal side. That's a real risk, and it's certainly not one that's priced into the stock market.
Yeah, unfortunately, Kevin, I know you're a student of history. I see a lot of mistakes from the 1920s and 1930s with beggar thy neighbor policies, currency wars, trade wars, tariff wars, and then the rise of popularity of socialism being repeated.
and also the monetary inflation of the 1920s, coupled with price deflation from a technological boom, which should have driven down prices, but those prices were offset by monetary inflation. And as long as the price level stayed level, which it did, it was almost, if you look at that, there was no consumer price index back then, but they call it the price level, and really Irving Fisher was, he was kind of a pioneer in this idea of tracking consumer prices and developing a price level. And it was basically flat in the latter half of the 1920s. And as long as prices stayed contained, the central bankers felt like they weren't doing any damage. And how does that describe what's going on today?
Exactly.
yeah, and we're following people. We're following the ideas of really Irving Fisher, and of course he famously said that stocks. I mean, he was the first celebrity economist. He was a cheerleader for the stock market. Stocks had reached a permanently high plateau, and then he got pretty much wiped out. And not only did that happen, but his
didn't
family.
The stock market crash within like a week or two of him saying that the stocks have reached a permanently high plateau?
It was pretty close. I don't have the exact date in front of me, but it was. But he'd been cheerleading the market for a while, so he probably was right for a while. But yeah, those are kind of the quotes that we remember. But his work in terms of monetarism, I mean, he was really the founder of monetarism, and but he got discredited, and that kind of paved the way for Keynes, and then later Friedman came along, and he resurrected the work of Irving Fisher, and Friedman. This was a huge influence on Fisher. Was a huge influence on Friedman, and he like I said, he resurrected his work and he popularized it, and he influenced the Nixon administration. Friedman did, was on the cover of Time magazine, I believe in the late 60s. And so Friedman really, his influence grew quite a bit. And what's interesting about the late 60s and the early 70s is he was concerned that monetary policy was too tight. And so you could say that, and also Arthur Burns, who was the Fed chairman under Nixon, was his doctoral professor, I believe, at Rutgers. And so there was another influence on Friedman, Arthur Burns. And so these guys are all influencing policy, and Friedman was concerned that the policy was too tight, monetary policy was too tight. So you could say that you could make a pretty good case that the inflation of the 70s, that a lot of that was brought about by Friedman and his followers and his influence. But isn't it interesting, Jason, that you talked about capitalism getting blamed, right, for the problems? Well, who is, when you think of free market economists, who's the first one you think of? Typically Milton Friedman. And yet Milton Friedman was a monetarist. He believed in this intervention in the monetary in terms of monetary policy, and Bernanke, Bernanke was influenced by Friedman. I mean, all these guys. So this road that we're going down, this path towards this great monetary experiment, a lot of this could be, you could say, you can't really blame it on Friedman, but certainly he was a proponent of these ideas, and yet they're not exactly free market ideas. So, we have to place, if and when this all ends badly, we've got to be very careful not to blame it on the free market, and make sure that the central bankers get their blame, their due.
Yeah, Friedman believed in prices, but not market signals for cost of capital and interest rates. He wanted government to have control of the money supply and government to have control of interest rates. And he also had some crazy idea. He wanted the money supply to grow with immigration here in the U.S., so he wanted like a 2% guaranteed growth in the money supply per year, I think.
Yeah, his whole thing was, and I think it first of all, this is an important distinction between the Chicago school and the Austrian school, and certainly there is a lot of overlap. In terms of like if you were to have a discussion about the minimum wage, they would certainly agree, and there's a lot of areas where they would agree. But the methodology of the two schools is different. The Chicago school is very much empirical, and the Austrian school is saying that there are, a priori rules that are based on logic and on deduction. That's basically a method that the Chicago school rejects, and so the Chicago school, I think of Friedman as being very dependent on empirical data, and so the problem with data mining is you're seeing correlation. Correlation does not prove causation, and so the problem is that he's looking at the what happened in the early 1930s, where you had a huge drop in the money supply. I think it dropped by a third, something like that, and then this coincided, of course, with the Great Depression. And so he looked at that and he said, well, if the central bank, all they had to do is prevent the money supply from going down, and there would not have been a depression. That's really the basis of his argument. And so anything that can be done to prevent the money supply from going down, that's what you need to do. In fact, it's better to just not even let it get near the red zone, keep it chugging along at 2%. And originally he thought that we needed a computer to do that, or we needed hard and fast rules. But it was interesting, back in 2006 or 7, I think it was 2006, near the top of the credit bubble, he actually published an op-ed in the Wall Street Journal, and he said, and this was basically almost an open letter to Alan Greenspan. He said, look, we've been friends and we've disagreed, but, I have to admit, he has basically proven me wrong, that a human being can manage the money supply and can manage it effectively, and I take my hat off to Alan Greenspan. Of course, that little gem he provided us, which was shortly before he passed away, that was right at the top of the credit bubble. So, just be careful about the ideas that he promoted.
Yep, he ended up having like an Irving Fisher contrarian indicator. Paul Krugman's been guilty of that too for a while now.
Sure.
Well, Kevin, I enjoyed our discussion today. I want to thank you very much for your time. You also had an interesting interview with a Swiss gold bullion dealer or a Swiss financial website in the last couple of weeks, and I'll attach a link to that in the information and description section. Covers other topics besides what we talked about in this interview.
Yeah, that was with my friends Christoph Geisiger with The Market. It's a Swiss-based financial platform, and they launched this earlier this year, and they have a German version and an English version, and a lot of it is subscription-based, but a lot of the English stuff is available for free. And they've had on some really impressive people like Jeffrey Gunlock and Jim Grant, and they do some really good work over there. So highly recommend it.
Excellent. And if my listeners want to follow your work, you're on Twitter, right?
I'm on Twitter, yes.
Okay, I'll attach a link to your Twitter. Thank you very much for your time, and I enjoyed our conversation, and we'll talk again soon.
Look forward to it, Jason.
Okay, I'm ending recording now.
Okay.